The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to another Lunch and Learn in our ongoing Financial Friday series. Sainies is excited to offer these sessions in cooperation with our corporate partner, AXA Equitable. AXA Equitable has a long-standing presence in New York, and a large portion of their New York client base is built upon the work they do in the public education system. Through AXA Equitable, Sainies members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Sainies members, which we urge you to take advantage of. It's a really great benefit. Our AXA Equitable presenter today is Keenan Miller, a Regional Vice President from the Southern Tier area. Now, before we get started, please note that all participants are muted during the session. And because we have so much content to cover today within our 30-minute time frame, we're going to ask that you send your questions to Keenan after the webinar is complete. And his email, and we'll repeat this at the end again, is Keenan, Keenan .Miller @equitable.com. And we'll go over that again. We're also recording this session, and it will soon be available at sainies.org. And I will email all registrants with a recording of the email link as well. So with that, I'll turn it over to Keenan.
Thanks, Michelle. You can hear me okay, yes?
Yep, I can hear you.
Great. All right. Well, hopefully everybody else out there can too, and hopefully everybody's safe here in Binghamton. We've got quite a bit of snow and ice, and I'm assuming a lot of teachers are home today, which is great. Get a good, nice cup of hot cocoa, and let's learn about some taxes here. So just a little disclosure, I'm not a CFP. I'm not going to sit here and say that I'm an accountant and know everything there is about taxes, but it does come into play with a lot of what we do in management of people's finances and protecting them now and preparing for later. And so we're going to cover some basics of taxes and really what's happened over the last couple of years as far as tax brackets and how it could impact you in retirement. So let's see here. My pointer is not working. There we go. So really what I want to begin with is talking about the impact that the Tax and Job Act has had on us over the last couple of years. The Tax Cuts and Jobs Act made a significant change in the individual income taxes and the state tax. And almost all of these provisions, however, will expire or sunset after 2025. So we've received some benefits. I'm going to go over those benefits, and most of them will sunset unless something happens in 2025. While most of the business provisions are permanent. And so, number one, what we see right here is really what the priority of this was the reduction of corporate tax, and then went from 35% down to 21%. So we really are aimed towards U.S. businesses and companies and trying to promote growth, higher GDP. So here at a personal level, what we can see is how that has impacted us as individuals. And so in 2017, we can see that the 10% tax bracket, we have a 15% tax bracket, 25, 28, and so on down the left-hand corner there. And what it changed to in 2018 was a 10, 12, 22, 24, respectively. And so for those who, and we see our single column here, and those who are married and filing jointly, the income ranges. And so for anyone who in 2018 was making between up to $9,500 that year, would be taxed, those monies would be taxed at 10%. Looking at single, so those monies would be taxed at 10%. Now, if you were making up to $38,700, the monies between roughly 9,500 and 38 or 39,000 would be taxed at 12%. So we can see there that there are significant changes and a reduction in our personal taxes, which means more money in our pockets in the long run. A lot of people were frustrated when it came to tax time saying, hey, I didn't get that much back in my taxes. And that's because we were paid more throughout the year. So switching over from talking about that income taxes, now we take a look at capital gains. All of this is important for us to understand as we get towards planning for retirement, because we want to know how our assets and our income is impacted now and later. So for many people, capital gains, for many people who have an account that would not be, let's say, a retirement account, but a non-retirement investment account, sometimes called a non-retirement brokerage account, a lot of times those are the accounts that you set up online for yourself, maybe playing with some stocks. Well, you're going to face something called long-term and short-term capital gains. Now, for those, when we are looking at long-term gains, again, we have a chart here for those who are making up to $40,000 this year. If you were to liquidate stock and have a long-term capital gain, you would actually pay no tax on that. Okay. For those who are in the next range of income levels are between $40,000 and $400,000 as a single filer, we pay 15% on those capital gains. Now, these ranges used to match up with these brackets. When we change, they no longer match up, so we have to watch. I mean, they're pretty close, but this first range here used to incorporate the first two tax brackets. It does not now. Actually, those that are in the 12% tax bracket today, that bracket is a little bit higher than this. So we really have to, when we're looking and working with non-retirement investments, we have to keep a lookout for these ranges, and you need to be working effectively in a plan and a liquidation strategy so that you're not paying too much in tax. We'll come back to this notion of having multiple buckets to be able to draw from in retirement to negate the negative impacts of taxes. Okay, so another thing that the Tax Act instituted for us is the standard deduction. We have a standard deduction change. So the standard deduction for 2018 prior to the tax reform was $6,500 for individuals and $95,000 roughly for the head of household and $13,000 for married couples. This is just about doubled, which is quite nice. So now the individual receives a $12,000 deduction, head of household $18,000, and married couples $24,000. So the Act retains the enhanced standard deduction for the blind and elderly that is available under the current law as well, and the amount of the standard deduction will be indexed to inflation. Okay, so increased standard deductions amounts will expire in 2025, the end of 2025. So this is one of those nice benefits that we're receiving now, and we have to plan for and be aware of that will sunset. Itemized deductions also change. One of the biggest impacts to individuals in the reduction is the ability to deduct state and local taxes. This will have a bigger impact on higher income states like New York. The deduction on mortgages interest is now capped at $750,000 for new mortgages. Another impact to individual taxpayers is the removal of miscellaneous items deductions subject to the 2% floor on income. So including the ability to deduct variable annuity losses and investment advisory fees. Miscellaneous itemized deductions not subject to the 2% floor are still available. So there have also been changes in the alimony that is recorded. So starting in last year, 2019, alimony payments were no longer included as income to the recipient, nor deductible to the payor. So covering some general topics that are pertinent to most people, now we start to look at, we've received some benefits, they've impacted us positively, but we need to start looking towards the future, and the history is important to look at here when we're talking about federal tax rates, because it shows that the tax law is always changing. We had a benefit talking about sunset provisions. Some of these things we may lose. So we got to pay close attention to these changes because they can affect our bottom line. For example, change in income tax rate, which we've been talking about, influences your investments and maybe even your home value. So looking at marginal versus effective tax rate, as you can see, some at the top of the 24 marginal tax bracket may only have an overall effective rate of 20%. This is important consideration when comparing investments that may have different tax characteristics. So coming back to this idea of multiple buckets. Now, I threw this slide in here to just see, okay, where do we compare globally with other countries? So we're looking at the United Kingdom and Canada and us. And we've been doing relatively well on an average tax rate on household income. So we're actually one of the best in the world. So when we talk about, here's another slide of deficits that are expected to increase. And so we take a look at slide 1 here. Taxes, are they getting lower? Could they continue to go lower? We compare that with what's going on in the world, and we look at our total deficits and surpluses. We take this information, we look at what's going on around the world, and we say, hey, we're in a really good position right now. Some of these things are going to expire, some of these benefits that we are experiencing. Why? Well, deficits. We have major things in our economy that need to be paid for, like Social Security and Medicare. And the only way to do that is to raise taxes. So where could the federal tax rate go? Well, your guess is as good as mine, but from what I've taken information from friends and family and other expert resources, many people feel that the only place taxes can go is us. So again, Tax Cuts and Jobs Act set to expire in 2025. Many of the individual tax impacts will sunset. Taxes may go higher in the future. So what does this mean for you? What will you get in retirement? That's really what we're getting to in the next couple of minutes here. We tend to sit down and we say, hey, I've been working for the state for 25 years. In 5 years, I'm going to hit my 30-year mark, and I'm feeling pretty good about that. I know in 30 years, I can get 60% of my income from my pension. So let's take a scenario here saying that what we need and what we come up with is I need $100,000 to take care of my household and my needs in retirement. As a joint couple, where's that money going to come from? Well, we just talked about, pension. 60% of my Final average salary right now is $60,000. Social Security, everyone has their own beliefs on what's going to happen with Social Security. But let's say it's established and we're good and we can take our full amount, $36,000. My computer decided not to work here. We'll get roughly a total of $96,000. I know that I've been saving my life, and I've got some money stored up in my 403B, and so to hit my $100,000, I'm going to pull $4,000 a year out, so that I have roughly that $100,000 of income. Well, let's talk about inflation. Let's talk about taxes. New York State pension. Well, one thing many of us forget about, especially if you're married, is that, hey, I have a survivor. If something happens to me, I want my spouse to continue on with my pension. Well, there would be a reduction in your pension, somewhere between 8, 10, 12%, depending on the age difference between spouses. You have federal tax that you need to, will be paying off of that. So your net income, really, when we thought it was going to be $60,000, is roughly $47,000. This is where Social Security comes into play, and because your income is so high at this point, 85% of your Social Security will be taxable, which is another reduction of approximately $4,500. Where your total income now is $79,000, with a shortfall of $20,000. This is really an eye-opener for us to sit back and to say, okay, now this is quite different. We just went from a $4,000 draw a year of our 403B to $20,000 a year, all due to taxes. So really, to generate the $100,000 in income that you need, we need to be mapping out roughly $130,000 to account for taxes and survivor benefit deductions. So how do we do this? How do we plan for retirement? How do we plan for our beneficiaries? How do we plan for our state? How do we plan for taxes? You have options. One of the things that I spoke about was 403B. That is your 401k. It is a way for you to shelter money now and pay taxes later. Well, you just said, Keenan, hold on a second. We're paying pretty low taxes now, and it looks like taxes may go up in the future. Why don't I pay them now? Well, there are tax-free withdrawal options as well, namely something called a Roth. Roth, you have municipal bond dividends. You also have life insurance retirement plans. Now, we're not going to get into the weeds of most of these, but I am going to talk about the difference between the traditional and the Roth. Many school districts already have a traditional 403B. Some do not have a Roth 403B or a Roth IRA, which we're going to talk about here. So what is the Roth option? This is where you're able to pay taxes now, receive your income from your employer, put it into your bank account, then make a contribution to your Roth IRA because taxes have already been paid. Those earnings grow tax deferred. So the account grows just like a regular or traditional 403B or IRA. You pick the investments, your portfolio, the money grows. However, there are no taxes paid while it's growing and no taxes paid upon withdrawals. Also, your beneficiaries, this can be passed on to your beneficiaries, and they are not forced to take RMDs. Traditional IRA contributions may be taxed. Any earnings grow tax deferred, again, until withdrawn, and taxes generally must be paid on any withdrawals. Okay, so putting your money in prior to it being taxed, it will grow tax-free or deferred. However, it will become income taxable upon removing from the account. Roth IRAs are fantastic, something many people should be considering right now. There's no lifetime required minimum distribution, no maximum age for contribution. Beneficiaries may inherit benefits, income tax-free, may not be counted as assets towards certain college financial aid. Certain amounts can be used for qualified expenses such as buying a first home, education, certain medical expenses, disability, and or health insurance premiums without paying additional 10% tax penalty. So a lot of fantastic benefits from the Roth IRA. So choosing the Roth versus the traditional. So even after all those benefits, however, Roth IRAs are not for everyone, and due to government regulations, they're not open to everyone. Okay, so a traditional IRA can sometimes be the best or only option available. Here's some general guidelines for choosing between two types of IRAs. Okay, even with a potential upfront tax deduction of a traditional IRA, the tax-free growth feature of a Roth IRA allows it to usually outperform the traditional IRA over time. And given the same internal investments, so the Roth is usually a better choice for younger people with longer-term investment horizon. Similarly, if someone has a low income, then maybe they don't benefit as much from the upfront traditional IRA tax deduction, and the Roth is a better choice. One big factor in deciding between a Roth and a traditional IRA is your expected tax rate in retirement versus now. Okay? If you think your tax rate will be higher in retirement due to years of savings and possibly inheritances, then the Roth idea would be a better choice, since it won't subject you to taxes or lifetime RMDs in retirement. Conversely, if you have a higher income now and are eligible for tax deduction, and you expect your tax bracket in retirement to be significantly lower, maybe in the 10 to 15% range, then the traditional IRA could be a better choice. So how do we set these up? Well, like I mentioned before, so we talked about IRAs, the Roth IRAs. Some of the school districts actually allow Roth IRAs, Roth 403Bs. So that is something where SANES and AXA Equitable can come together and negotiate and work with the business managers in the schools to actually put a line item in there and have approved a Roth 403B. And we've done that in many schools around here. So that now you have two buckets an employee can pull from in retirement and to help them navigate taxes in retirement. Aside from that, you always have the opportunity of working with an advisor and setting up your own Roth IRA or traditional IRA. They can be great companions to your already savings plans that you have set up. And as we saw before, it is more important now than ever to be setting up your own individual savings and not just relying on the state pensions and Social Securities. As we saw, things change. Politics are in action. So protect yourself and start to work with someone who can help you, like I said, navigate these pre-retirement times, in retirement, and post-retirement. Already covered this, but yes, advantageous for those who are young, but even someone who is nearing retirement as well. We've used the Roth IRA quite a bit because you do have the ability to pull for big purchases later in life. So even if you only have 5 years until you retire, not a bad idea to have this sleeve because, hey, if you want to buy a car and you need to pull $5,000 out, let's pull it from the non-taxable sleeve instead of pulling it out of your fully income taxable sleeve. So really, right now we come to the conclusion of today talking about taxes. We're a couple of minutes early, but right here you can see the different representatives you have throughout the state, whatever region you're in. I run Region 9, and I'm part of also the Syracuse office. So 8 and 9, and any questions there, feel free to reach out to me or my partner. His name is there, Greg Ronenberger. Any of the folks on this page will surely love to take your phone call, talk with you, help you set up a great retirement plan that will navigate the chaos of taxes in retirement. So, Michelle, I'm going to turn it back to you. Thanks so much for your time, everyone.
Terrific. Thank you. So as we mentioned, we'll do follow-up today via email. Like Keenan said, if you have those questions, you can email him or any of the advisors on the screen. Again, I'll pass on the email, KEEN.Miller@equitable.com. And I think that's it for today. So thank you, Keenan, and have a great weekend, everyone. Bye-bye.